Hey guys, Freaky Finance here. This week we're gonna look at Crocs. This is a different video. Normally I try to do them when I'm thinking about getting into one. This is one where I'm thinking about getting out of one. So Crocs is one I've picked up. I was actually trying to get it cheaper, and then I just kind of took off with a couple other things. And I'm kind of at this point where I'm like, should I sell it? Should I not? Longer term, it looks pretty interesting. Anyway, we'll get into it, and I think this will help me make a decision. Here you can see I do have Crocs. Basically picked it up in the 80s when it was starting to pull back. I was really trying to get it ideally in the 60s, kind of like thinking about kind of like the Celsius plate, which kind of also just took off quite a bit. Things have taken off lately, and part of it I'm starting to see more and more opportunities in China, so I'm trying to get more into there as well. But that's neither here or there for today's video, but it's kind of this high kind of recycle or profit back into other ideas, and this is a constant process that I do. So anyway, Crocs, most people know what it is. Today I want to be a simpler video, mainly because I just been super busy this week, so just an easy one for me to explain. I don't have to go into detail. People kind of know what it is. Shoes, footwear, and relatively cheaper footwear. That has gone through kind of like a fashion thing where it first started. Some people really hated it. It was really polarizing, but some people were like, well, it's super comfortable and super cheap. So anyway, here we are today. It's actually still growing. It's actually growing even quicker during COVID. Partially because of maybe work from home, and partially because of comfort, and I think the product offering has improved over time as well, to the team's credit. But you can see they have women, men, kids. They have a giblets thing we'll talk about quickly. Crocs at work, so nursing shoes. So they have a lot of different SKUs. They also have a decent amount of customization of what you want on them, partially because they're so cheap to make. And they also have partnerships, like Lucky Charms, you have McDonald's ones, you have Disney ones, and then when you have like a new movie coming out, like Kung Fu Panda, you might see Kung Fu Panda ones with little giblets to match too, Panda ones, right, and the Barbie and Hello Kitty and Shrek. So a lot of partnering. Anyway, in terms of the business, it's still largely North America. It's still largely physical. Still largely Crocs. We're going to talk about Hey Dude. It's actually part of the business I dislike right now, and it's hard for me to tell what the value is here and what they're thinking when they bought it. And then you can also see it actually have quite a bit DTC, which is nice. I don't know. I just view DTC as a superior channel to sell. You just have more control. You can see here that they acquired Hey Dude. I think it was about for $2 billion, which isn't small for a company. Crocs is only worth $7.5 billion right now. They made a relatively large acquisition to a company, and in my eyes, so far, it's been a dud. Talked about the two distribution channels already. You can see the DTC has kind of been bouncing around 49, 45, 48. And they do have the wholesale channel. That's your domestic, your brick and mortar retailers. And you can see that shoot up to 52. In terms of the company operated retail stores, you can see it's still largely United States, but surprisingly enough, probably to most people, there's a lot in Korea, a decent amount in China, and a decent amount in Singapore, and relatively lackluster penetration everywhere else in the world. And honestly, it's probably underpenetrated everywhere still, so I think this is a long-term growth story, and to be fair, it has been growing. The giblets are kind of like a customizable thing, so one of the things I like, and that's really what I like about Crocs in the long run, is that you have this easy, cheap to make product offering, right? It's comfortable. And then you have a way to customize it however you want. So they might make these a bunch. You have Kung Fu Panda shoe, you could have different giblets on it, or gibbets on it, whatever they call it. Anyway, and I think this is a cheap way to make customization. And I like this. This is, I think, going to keep trending. They also have ways to make cheaper sandals, right? Not 29% growth year over year. So this is a pretty big grower. We're talking double digits. I like that. Hey Dude, on the other hand, like they talk about brand awareness here, which makes you think that it's growing, right? Oh yeah, 32% brand awareness. And then you look at the sales and you're like, oh yeah, okay, that's why you're not talking about sales. Because basically it's been a dud since they bought it. Again, in my opinion. Here you can see the margins, which are very high. Crocs are cheap to make. And they make a lot of money on them. So almost 60% margins on Crocs. You can see Hey Dude is actually lower, so the more percent of sales that sell from Crocs, the sales mix margin will actually improve, versus the more they sell in Hey Dude, the sales mix margin will go down. Now, part of this is because they were discounting to move product at Hey Dude because it wasn't selling. And we have seen inventory, we'll talk about the balance sheet in a second, actually improve. But you can see really healthy growth margins. The company is highly profitable. We'll go into the financials really quick. Normally I'd write these out so you can see the trend over time. But this week's been super hurry, so I'm trying to do the reason why I'm doing Crocs is like, what's the one that I can explain super easy? You can see here pretty strong year-over-year income from operations growth, 21%, right? They do have some debt, but they actually paid off a decent amount in 2023. We've seen the EPS just shoot up from quite a bit, right? We're talking about almost $12 earnings power. The company's at $125 a share now. Yeah, right around 125 a share. So about 10 times earnings. So not crazy cheap, not crazy expensive. It's kind of in the middle. For a company that's growing as fast as Crocs is, you could actually underwrite that and say it's cheaper, so it could keep going up. And that's kind of the trick I'm at right now. And I already mentioned the gross margin trickling up, operating margin trickling up. On the negative, we actually see a lot of them increase their SG&A investment. And we'll talk about that as well. It's hard to tell why they decided. Part of this, I think, is to try to support the Hey Dude brand more, or at least some type of cost is connected with that integration. But it's hard to know why it's deleveraging when it's literally been a history of SG&A leverage. We'll go to the track record of it to see. But you can see they took a lot of price. So they only actually sold 4% or 3.5% more in volume year over year for Crocs for the 2023 year. But you can see they took 9% price. So that's the reason why you saw gross margin expand. So they took a lot of price, and you can see how cheap they are, right? $25 for a pair of shoes. It's pretty cheap. Whereas you saw a decline in average selling price because they had to promote to move these things because they actually had shoes that they could not sell without discounting them. And they talk about that here as well. It showed up. This slide on page 37 of their 10K for 2023 is pretty informative. Balance sheet's actually not bad. It was better before they bought Hey Dude. So they took on debt to buy it. You can see then that they actually paid down quite a bit of debt. They actually paid down, well, they went from 2.3 to 1.64. So a decent chunk of debt in the single year. Call it $650 million. Not bad. And we also saw inventory go down, which is good if we want margins to stabilize for Hey Dude. Ultimately, margins weren't a problem for Crocs. Sales weren't a problem for Crocs. You can see the bottom here, retained earnings are just accelerating. This company is making it at quite a lot of money, right? 800 million increase in retained earnings year over year on a company that's only worth 7.5 billion. So it's pretty impressive growth for its current valuation. But ultimately, the market's probably not sure if it can actually grow like they've guided to. Here you can see what sounds like a sore thumb to me is this is the cash flow statement. You can see the $2 billion that they spent on Hey Dude right there. But you can see pretty strong, like you're talking 550 million, 603 million, 930 million cash from operations, and they only had to put in, call it 100 million back to the business. So basically they had a $800 million surplus here. They basically paid down 650 million in net debt, and then they bought back almost 200 million in shares with the decrease in cash making the delta. But anyway, you can see it looks clean, and it's always nice when a business is super easy to understand. So, and you can see it is improving over time. Now, how much of that is from the COVID work from home shift? How much of this is just international expansion? It's hard to say, but it has been, like we've seen this now for 3 years where the growth has just been pretty steady, and it's overcome any kind of macro goods pullback. Well, at least Crocs has. Hey Dude was not so lucky. Here's just another way to show the inventory pullback, which is nice, right? Basically, that's a way to stabilize the Hey Dude inventory issue, right? That's on the small decline, going from 169 million to 104 million for the Hey Dude brand year over year, like in terms of percentage-wise, which should help in the back half of this year. That's kind of what they're saying. I'm not sure if I believe them or not. They are pushing pretty hard internationally. They say they're growing 23%. They say they grew triple digits in Australia and China, so the APAC side, and South Korea and UK grew double digits. So I just think they're very underpenetrated around the world to where the population is. They're still overly indexed to North America and the States. The guidance is interesting. So you have, again, fairly steady growth at Crocs. I think they're kind of sandbagging this Crocs revenue in case they miss on Hey Dude, they're going to beat on Crocs. That's what I think they're trying to set up here. I don't know that, but that's what it looks like to me. And the thing that's weird to me is when you start Q1 down 20% for Hey Dude, so again, another bad quarter for Hey Dude, but then you tell everyone, well, no, but we're still going to be flat to slightly up for the entire year. That means you have to dig yourself out of a pretty big minus 20% starting point. And I think the market's not sure about that. Obviously, right now it's going up, which is why for the video. But the reason why I bought it was because of this. I was like, okay, I think Crocs is actually going to keep performing, and I think Hey Dude's going to be crap as people think it is, because it has been so far. In terms of the latest conference call, we're seeing some pretty good success on marketing in Korea, so the K-pop side, and that is interesting. So that could tell me like maybe they're going to get some decent heat on TikTok and stuff like that. Maybe they have something, they've unlocked something there to keep these double-digit growths going, right? And it is impressive. Like they are branching out to other product forms, like sandals grew 29% year over year, which is pretty impressive, right? Breaking out of just the standard Crocs. This was interesting. So we actually saw SGA deleverage last year, not by a small amount, right? 4.3%. And they say it's due to continued marketing investment, talent, and infrastructure. But again, none of these tell me really anything. So I don't like that because that's opposite the trend. So I think part of this is them trying to support Hey Dude more. But they didn't say that here, but that's just what I think. They are guiding, like I said, for Hey Dude sales to improve during the year. But so far, it's never actually happened yet. They say part of the catalyst there is opening Las Vegas DC and implementing the ERP. So it could happen or something here, at least. It's not just them hoping. And then again, the guide is over $12 earnings power, which is pretty strong. And this is probably the top question in my eyes. It's you have some reasons why we should expect better performance, but it seems like you're kind of digging yourself a hole, and you need a pretty significant reacceleration for the remainder of the year for Hey Dude. And I think that's kind of like the $1 million question, whether just selling now is a good idea or not, is if Hey Dude can actually beat, because the street is negative on Hey Dude for a reason. It hasn't performed. And I think Crocs is also probably cheaper than it otherwise would be if they don't make acquisitions like that ever again. Like they probably would be better off if they just focused on Crocs and those little giblets and just sell across the world in populations where they're underpenetrated. I think they have an easy way to grow there. So why do you need to grow inorganically by acquisitions which you fail to tuck in? And this was an interesting question again, because it's kind of like your outlook, assuming relatively stable gross margins for your Crocs business, which is weird because, like I said, like we saw, they just took price and there was basically no impact to revenue growth, unit sales, right? And their answer was kind of weird. Like they're like, well, we're expecting, in 2022 we had significant freight headwinds, so maybe they just had part of the reason why the margin expanded is because they didn't have them in 23, right? But we saw them take price. And they basically say we're not going to see it on the margin side because we're reinvesting it back into SGA again this year. We're investing in India. So we'll have to see how this goes. It's just a weird answer. And I think that's why they're probably under-guiding Crocs and over-guiding Hey Dude. In terms of like a longer run setup, the reason why Crocs is just, in my eyes, is just so easy because they only have 4% of the revenues in China, right? So they're growing triple digits year over year, but I mean, you're only 4%. Like this could be a huge unlock. Like you could get to 20% China sales, right? Pretty quick if they wanted to, and they are priced pretty cheap. So I just think this is the easy step up. Like they can easily grow internationally, and they do have a decent brand awareness, right? They've been around for so long. Brand has always been slightly polarizing, and they've done a good job with product innovation over time. They did talk about the Red Sea and how it's impacting, and they said basically just increasing the shipping time. So far, not the shipping rates. I have seen shipping rates go up in the back half of this year if you're trying to lock in for a contract. But for current spot prices, like supposedly they're not seeing anything, which is always a good sign. In terms of who owns it, normally I would find somebody that I've seen before that I looked at, but honestly for this one I haven't. I think part of that's because it's smaller, growthier, and it's more retail. Usually when I'm in retail, I'm bin dumping, right? I'm getting to Kohl's, right? That kind of stuff. I did look at Broad Peak to see who they were, and they're from Singapore, which is kind of interesting because they're fourth largest geography. They're in Crocs, their top position, and they have China and Skechers, LVS, which again is Singapore, Winnebago, which is interesting. But you can see they've been net seller this whole rally, so we'll see. It's just worth pointing out. I always look at them to channel check. This is the reason for the video, is that it pinged my top of the Bollinger Band for standard deviation move up, aka it's generally a way for me to be like, hey, you should consider at least looking at it to sell it. And so that's where we are now. Over time, you'll be like, oh my god, no, this thing looks expensive. It's run up so much. The fundamentals for Crocs have been very strong these last 5 years. And so you kind of had the question, will that continue? Will people want to buy dress shoes again? Stuff like that. Or was this an easy way for them to get market share awareness during the COVID pandemic, which is a permanent rate of change improvement on the brand, right? Just more and more brand awareness, more people wearing it at home, more people find it comfortable, it's cheaper, blah, 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 whatever. And so like on a stock chart, you're like, okay, no, it's definitely expensive. But when you look at the fundamentals over time, the business has gone from 1 billion to 4 billion in sales. More importantly, you can see here, while they're still only doing $1 billion in sales, they're only making $62 million in operating income. And all of a sudden you can see it go 1.2, and all of a sudden it doubles, 1.4, doubles again, 2.3, it triples, right? So we've seen material improvement in operating income and pre-tax income, and now we're at $1 billion, right? So just imagine you sell $4 worth of stuff, you're able to pocket $1 of that, 25%. And that's pretty strong shoes, especially for this type of growth rate. And so I am kind of surprised. Like if I were to look at this backwards looking, I could see the market in the current setup writing this at 20 times earnings, not just 10, right? I could see that happen. So it's kind of a tricky thing to decide, should I sell now just because it's higher, or should I ride it out? And we are seeing some buybacks. Like, I don't know, it used to be at 75 million shares outstanding, now we're at 60 latest quarter. They have bought back a decent amount. It would have been better for them if they decided not to spend any money at HeyDude and just keep buying back shares over the last 2 years, because they actually generate a lot of cash flow to buy back shares at this current valuation. We'll have to see what happens. It's definitely an interesting company, and this is probably the only critical weakness to them, and maybe why they're not guiding that they're going to take price again for 2024 for Crocs, really, or limited price takes, I'd say, is because of the knockoffs. So you have B-Slip, I just typed Crocs into Amazon. This is what shows up. So you can see that they do have a lot of competitors that are basically half off whatever the Crocs brand is for the same type of shoe. That's just my thoughts. It's probably the only critical weakness to these guys. But so far in the long run, they've definitely performed. That showed up on the share price, and it showed up in the financials. The margins are great. The cash flow is great, right? So if they can keep growing like they have been, the company is probably great. So it's a tricky time. Whenever I see it on the Bollinger Band, it's kind of like a process note. It's like, okay, I should at least make a decision whether to hold or sell. So anyway, I like to know your thoughts on Crocs. It's always a fun one. And have a great rest of your weekend.